Good morning, everybody, and welcome to a special Business Works. This is on the PPP, the last rollout of the PPP, and other grants that might be available to business. We have Dale Gillmore, who is the Business Growth Chair of the Lake Norman Chamber of Commerce. I'm the President and CEO of the Lake Norman Chamber of Commerce, Bill Russell. And I want to welcome everybody for joining us. I want to remind everybody we are recording this. We will place it on our YouTube channel and share it out with social media later. And I know there's going to be opportunities that Dale and Ron are going to give to allow questions for people. So Dale, I'm going to turn this program straight over to you.
Okay, thanks, Bill. So I appreciate everybody for joining. This is a little bit of a follow-on to one we did before with Jay Lessman and Richard Pappas and Jeff Tart maybe a month or two ago. And when we did it last time, the Consolidated Appropriations Act had not yet passed. So now it's passed, and there's a lot of changes that have come about, and most of them are favorable to most of the people we're working with. But you know, there are some very different rules this time around, and some things that people have to pay attention to. And there's a couple opportunities probably hanging out in that 5,600 page act that was passed. So Ron Niekro will be, I'll kind of facilitate kind of questions, and he's going to help to sort of answer those. And you know, the program will be basically PPP round one sort of updates, just to kind of get that housekeeping out of the way, but then jump into PPP round two. We'll talk about a little bit about the employee retention credit and the changes there. And then also at the end, just open it up for Q&A for the folks in the room here. And, you know, I see Jay's out here. Jay, don't be afraid to join in and help answer, since we know that you're knee deep in this stuff too. So anyway, so why don't we start? You know, Ron, could you maybe share just the basics of what was sort of updated for PPP round one and the Consolidated Appropriations Act, you know, with regard to taxation and forgiveness, and any significant items that have jumped out from the Consolidated Appropriations Act?
Sure, I'll do my best here on those, on the updates. You know, just understanding there's, you know, always questions that come up, and you know, always the hope that SBA and Treasury give more guidance. To be honest, I'm tired of reading guidance and reading releases from them, but we'll get through some of it. I mean, one of the main changes to round one that they did retroactively is, we think back of what was kind of the cost, payroll, non-payroll costs that can be used that allow for forgiveness. You know, there was the, you know, payroll cost and what's included in payroll costs. There was rent, utilities, interest. The one thing what was added with this act was these additional non-payroll costs that qualify forgiveness, and it's covered operations expenditures. Again, there's a little definition of what that would be. Covered property damage costs, covered supplier costs, and then covered worker protection expenditures. So, you know, PPE, masks, those type of things. So they added, you know, they added some additional expenses that can, you know, improve your chances for forgiveness. Again, they didn't change the period of when that had to be, you know, spent. That had to be spent during your 8-week or 24-week period of whenever that started. But again, for the companies that were still close to not spending all the PPP funds, at least on forgiveness items, there was a benefit there. On the taxation side, you know, kind of one of my favorite topics. Again, this is for federal purposes. Again, any forgiveness of the loan is not, you know, it's not taxable income. You know, that part was in the original act. But what this act did, it clarified and was firm and overrode the IRS that the expenses are still deductible. Because the IRS previously ruled, you know, in the middle of last year, that any of the expenses covered by the PPP loan, if forgiven, were not deductible. This legislation overrules that, and so that we don't have that issue anymore. And they also expanded the language on that to make sure the IRS can't go around and say you don't get basis, or finding other reasons to somehow create taxation on that. So that was another benefit in that act. On the forgiveness side, I mentioned the additional expenses. They then added for loans under 150,000 that there was, kind of made it a simpler process to get forgiveness. It's still, haven't looked at it in a while. It still seemed like it was a page or two that had to be completed and submitted to the bank. So there still was a process, but the overall should be more efficient and easier. But the forgiveness applications are still being, submitted to the banks, and the banks are still, handling that through the SBA. That continues. And there was recent notice that came out, not a notice, but just kind of say an issue with the SBA as they work on round two, the second draw loans. If some of the forgiveness applications are still in process, it's causing a delay on approving round two or second draw loans. So that's being worked on, being resolved. But again, overall, they clarified some stuff on forgiveness, added some additional expenditures, and confirmed that you're not going to have a taxation event by getting these funds, using them for the appropriate purposes, and then getting the loan forgiven.
We've had a lot of questions from our existing clients about several things, and one of the questions, and I think it's probably a good time to talk about this and clarify, but one of the questions that we've had was, there's two pieces. One is, hey, can I go back and amend my PPP 1 max loan calculation and try to get more money? And I believe the answer to that is yes, if the calculation if there was a mistake in the original calculation. However, nothing changed, I believe, and Ron, you can correct me if I'm wrong, nothing changed with regard to how the max loan calculation is done. The only thing that really changed was the forgivable costs were expanded. Am I right on that, Ron?
Yeah, so there's, nothing changed on round one on what the max loan was, but again, that's because there was guidance that was coming out continuously last year. And the one example it's usually for partners or partnerships and guaranteed payments and kind of the mishandling of that. But if you didn't get kind of the max loan amount you were eligible for, yes, you can go back and get those additional loan amounts for round one.
Okay. All right. So shifting gears, I mean, some of that is old news a little bit, except for what was updated with the Consolidated Appropriations Act of 2021. PPP round two. Is there any difference in how the max loans calculated for round two?
It is still 2.5 times your average monthly payroll costs. And I didn't mention this with the updates to round one, but there was the clarification, on the health or kind of the benefits, life insurance, disability insurance, in addition to health and dental and vision are included in payroll costs. So again, 2.5 times average monthly payroll cost, the cap is $2 million now. Previously it was 10 million. But for companies that are operating with a NAICS code starting with 7.2, so food services and accommodations, they can use 3.5 times of the monthly payroll cost, still capped at $2 million. So, I assume hotels, restaurants, but anything, again, food service, accommodations, they can use 3.5 times instead of 2.5 times.
Okay. And what the qualifications to apply for the loan, what's too big? How many employees do you have that?
So to qualify, it's 300 or fewer employees. You had to have a 25% decline in a quarter of revenue. And that's a calendar. They'll look at that as a calendar quarter. They did provide some guidance, I'll say relief, that it could be an annual basis if you have, annual tax returns for 19 and 20. I don't know who's going to have their 2020 tax return that far along at this point. But, and then the third item, you have to test that you have spent or used, or you will use all of round one for the appropriate cost. Again, so that's the three kind of qualifiers. Again, 300 or fewer employees, 25% decline in your revenue, and a test that you used or will use all around one. The 25% decline, the guidance is, the kind of question comes up is, what is revenue, or what do I include in my revenue, or how do I calculate my revenue? So, typically it's going to be a gross receipts. You probably should follow, I think the guidance says that, follow what you do for your tax return. So if I think of method of accounting, cash versus accrual. So it's however you're filing your tax returns. If you're using cash basis, you should calculate gross receipts on cash basis. If you use accrual basis, base them on accrual basis.
Yeah, and I think we just we had this question, and so calendar quarter, so kind of January through March, April through June, July through September, October through December. Those are the calendar quarters, or annually, which would be just the full 12 months with the 25% calculation, right? But one of the things that we kind of were talking about too is that it's probably really important that you communicate with your CPA a little bit about this, especially if you haven't filed most people haven't filed their 2020 tax return. But the reason is a couple reasons. If you look at the basis and measure of how you calculate your gross receipts, you might not realize it, but maybe you ship the product at the end of the year, but for whatever reason you didn't invoice it until January or something. That could actually be the thing that created the difference one way or another, whether that's 19 or 20, or that could be the thing that created the difference between 25%. So if you're close, especially if you're very close, but you're not quite there, it's probably worth just digging in a little bit with your CPA and making sure that you're really recognizing revenue appropriately in those quarters based upon your method of accounting. It'd just be kind of quick advice to share, because we had a guy we talked to this morning that he's like, well, I can get to 25%, but ideally that's like March, April, May. Those are my 3 months, and that's not a calendar quarter. So we know that's not a calendar quarter, so he's not going to qualify that way. But one of the things we wanted to make sure he did was kind of look back to his tax method and the way he filed his tax returns. And we suggested that he also look at, kind of the timing of his revenue recognition, regardless of what he may have put in his books, right? So sometimes revenue recognition can be based upon when products are shipped, or when the invoices happens, or when all the sort of right to earnings happen. There's lots of rules around revenue recognition, and it's worth talking to your CPA about it, especially if you're on the borderline of this 25% threshold. And your hope was that you would qualify. So I would spend some time with Jay or any other CPAs in the area that you're working with, and dig in a little bit if you're close.
Yeah, and so just clarify, firm, it's only one quarter, right? So you compare one quarter of 19 to 20, so you don't have to have a 25% decline in every quarter. Just has to be one quarter of that year. But the SBA and their kind of Q&A, they say calendar quarter. They do mention that some taxpayers can be a fiscal year payer, and there's some verbiage around there, but nothing came out that allows you to do anything other than a calendar quarter. But again, yeah, you got to be familiar with how you recognize revenue for your income tax returns, and then when you submit the application, just to add on that, you'll have to provide documentation of how you get to this 25% decline. So for 19, the most thing you're going to have for 19, you can have a tax return, but you still have to break out the revenue by quarters. Not everyone's going to have audited or CPA prepared signed financial statements, but again, what's been provided there as applications have been provided is, you can have your internal financial statements, but the owner or officer of the company has to has to sign and date kind of page 1 of that profit and loss statement, and then initial any other pages for both years if they don't have audited financial statements. So the SBA, or first the bank will be asking for that if you don't have that ready. And then I think at the most part, the SBA is kind of just, if the banks have done their thing and followed those kind of guidelines, they're approving.
So Ron, question on just process with banks, and all the banks are different, but this time around, it doesn't feel so fast and furious like the first time around when we had these to deal with. But do the banks, are the banks' processes a little bit easier and more efficient this time around, or what? Is there anything differences that you would say, or make sense to share?
Yeah, the banks. I would say the banks have seemed to be more efficient. It's still going the SBA, and I see that's taking the same amount of time or maybe a little longer. Some of that could be because, when this kicked off, say January 11th, they actually didn't have the specific guidance on what the documentation on gross receipts of having, audited financials or signed and initial financials. So some banks were in the process and had already collected the data and was sending it, and now they get the guidance, 3 days later of, no, we need this. So I think that's causing some delays, but it is not, I think that first round, look back, it was April of last year, that first round, I think within the first month, they were out of the funding for it. I was just looking earlier today, for the first 2 weeks so it's been open 2 weeks now. It's almost a $300 million kind of program, and they processed up to 35 billion, I think I saw. So there's a lot left. So I don't know if that's necessarily the pace. There is some of it. There's just less companies qualifying, and so that's so that may make some things a little more efficient. Yeah, but it is the review. Kind of, you're going to have the banks reviewing these internal financial statements. If you have your internal QuickBooks, it may not be the clean. You may have revenue, and the top page, you may have other income on the third page. Someone's got to add that up. Now you're going to have a person at the bank manually adding that up. The one good thing, and I haven't seen some of the banks really handle this well. For the first round of PPP, if you use 2019 payroll for calculating your max loan, and you're using the same bank for the second round, they're able to or supposed to rely on the documentation they received last year. So you shouldn't have to submit payroll documentation again. But I've ran into issues with some of the banks, just their portal's not set up to do that, and I'm still uploading last year's information. But if the bank has that set up properly, and you're using 2019 payroll again, really you're just additional you're filling out the application, and the documentation you're adding is your gross receipts documentation. And then again, I didn't really touch on that, but when you think of the payroll costs, you can use 2019 or your most recent 12 months. So if you were applying at the beginning of January, your 2020 payroll or payroll costs would be something you're looking at. I think for most companies, I think 2019 payroll is probably going to provide the larger loan amount. Gotcha. Especially if you had gross receipts of 25% or decline, I assume payroll would have declined as well. So.
Yep. Okay. So probably a good time to pause there, and we'll get into the employee retention credit in a minute, but pause there and kind of open for questions. I got a question here. Looks like Jay Leisman has a question. Jay, you want to jump on?
Yes, sir. Yeah, this is kind of adding on to what Ron was saying. And I know we have some bankers on here as well. The most frustrating things our clients are running into is the different bits of information each bank keeps asking for. or allows you to, enter or not enter. Like one client had was only being allowed to enter the annual income, not quarter by quarter. And annually they were really close to being the same, but they had a big dip. So you have a lot of, I think, frustration coming toward the information being asked for by the banks when SBA is saying this is what we need, but banks are asking for other things. And Ron, I don't know if y'all are, or Dale, y'all are seeing the same thing, but it's just like, if it's standardized at SBA level, it would have been nice if they had said, and banks that are doing these loans for us, we're going to hold you accountable only to this information and not to more, because that's why we're getting asked for more information, because banks are scared they're not going to be able to support the loan.
Yeah, that's what I was going to add. It's more that, the banks without the specific guidance and something written by the SBA, they got to make sure they have the documentation for when it gets reviewed later, so they don't end up on the hook for the loan on relying on just something that's not specifically written from the SBA of what they're really going to require. So that has been a little bit. It's been, on the other side, it's been interesting for these applications. For some business owners, they have multiple entities, right? All the entities probably do qualify or have qualified, but I haven't seen really the banks or the SBA yet put together a request for what the affiliated group in total looks like, even though they would qualify. But that's so kind of goes both ways. Some banks have been a little that I've seen have been a little less following up on, we want more information. But yeah, Jay, it's kind of been bank by bank.
And one of the things that we've come across too is, and maybe it's worth talking about here, is where sometimes people have kind of all their employees in one entity, but they got multiple entities that those employees serve, on who the applicant should be or could be. And really it's really the business that's using those employees, most likely. And so it's if you think of a PEO, it's still the company that's using the PEO that's applying for these, right? So I think it's important to know that sometimes it looks like I know of a group that that applied at the kind of the paymaster level and where all the employees were, and now this time around it doesn't make sense to do it that way, because not all of the businesses that those employees work for qualify. Some do and some don't. So they've got to go back and they may amend PPP 1 just to kind of change that. And PPP 2 is they're going to do it by entity. So I would think it's important to sort of think through how if you got multiple entities, what's the best way to accomplish that. And of course, you're going to try to work with your CPA on those kind of items as well. So anyway, any other questions out there on the PPP before we start talking about the employee retention credit changes?
Well, two things. I think I mentioned earlier, just to be clear though, if you're seeing any delays or hearing delays, again, the most recent one I saw was the SBA delaying kind of the review and approval of the applications because the loan forgiveness application for the same company hasn't been approved or completed yet. That wasn't, the rules didn't say you had to have loan forgiveness completed. It says you have to attest that you've used the funds or will use the funds from round one. But that's been the most recent kind of outcome of the SBA review of the applications that's causing a delay. And then one other item, again, it's not PPP, but it is, help for small businesses, but there's the shuttered venue operators grant. which can be up to $10 million, or the lesser of $10 million, or 45% of your 2019 gross receipts. But shuttered venues, the movie theater, live concert venues, promoters. So anyone that's going to have kind of in that space, there's a shuttered venue. It's a grant. Again, 45% of gross receipts you can get up to. And you got to use it for similar thing, payroll costs, rent, utilities, similar things in the PPP. If you qualify, you're going to get the shuttered venue grant. You can't, and you're not eligible for the PPP. But again, it'd be a better program if you're in that space.
Yeah. So Bill, just as a thought out loud, any chamber members that are movie theaters, have live entertainment, or had live entertainment, maybe. So this is something that's probably not, 6,000 page document. It may not have jumped out to everyone. And that's probably a super beneficial thing for some of those folks. So might be worth, maybe sharing that with members that make sense in your membership.
Yeah, I mean, you got museums, you got aquariums, you got movie theaters.
Yeah, that was a good point. Thanks, Ron. Any other questions out there from the rest of the crew on the Zoom call here? All right. If not, we'll go ahead and move into the employee retention credit. Ron, you want to just sort of tell us what it is, and then kind of we'll move through the progressions there.
Sure, I'll try. I thought you were doing the retention credit.
You want me to do it? I'll do it.
Retention credit, employee retention credit is a credit that employers can get for qualified wages that they're paying to their employees. This was around last year, but if you received a PPP loan, you weren't, based on the original rules, you weren't eligible for the retention credit. So they updated the rules that kind of repealed that part of legislation that you've got the PPP loan, you couldn't get the credit. So that's allowed now. But they extended it to June 30th of 2021, and then changed it. So for 2020, 50% of gross wages paid to an employee, I think it was up to $10,000, so a $5,000 cap per employee. That's the 2020 rules. It's a credit to the employees. Typically it would have been on your payroll tax returns. You can file for 2020. You can file amended payroll tax returns to get that credit. And if it is for 2020, a couple of things to be eligible. And Dale, you add to this if I mess it up, but it was, you're kind of shut down or had to close or kind of partially or fully suspend your operations due to some governmental order because of COVID-19, or you had a decline in revenue of 80% or more in 2020, but that 80% is now 50%, I believe.
Yep. 50% in 2020 and
2021. 50% in 2021.
Yeah, that's right.
80% in 2020, or you were, following orders for governmental orders to shut down. The credit, was 50%. It's 50% for 2020 wages. That credit is now 70% of qualified wages for after January 1, 2021. There's one threshold of 100 employees or less to go through this process. If you have more than 100, I think you can still get the credit. There's just a lot more work to do. What I say, $5,000 cap per employee in 2020. Since it goes up to 70%, it's a $7,000 cap per employee for 2021. Again, by quarter.
You can't use wages that qualified for the PPP loan in 2020. Is that right? It's only wages
that you can't the wages that were paid from PPP loan funds, that won't be part of your qualified wages.
Yeah.
So you gotta kind of look at the 8 week or 24 weeks. So if you used your PPP loan funds in that 8 week period, or say even 10 weeks, kind of anything after that, then you may want to look at the Q3, your Q3, Q4, 2020. Look at wages paid in that period for this credit.
Yeah, and for the businesses that don't qualify for the reduction, the 50% reduction, you can still look to, and there is not a bunch of guidance on this definition, but you can, if you don't qualify for the 50% reduction, you can still look to operations that were either fully or partially suspended by a COVID-19 governmental order, and only during the period the order is in force. So we had, there's lots of ways to kind of read into that. I mean, the counties had some of their own things, the towns had some of their own things, but Governor Cooper's orders that he had, we've had a hard time deciphering this for ourselves. I mean, I'll use us as an example, our firm. We never really shut down. We had people work from home, but we never really shut down. So, and there were orders that, we needed to stay at home and things like that. And we could kind of measure those periods of time. And so there's not a ton of guidance here. I think you got to really think out loud with your CPA and spend some time on whether you think you were impacted enough by the government orders and decide whether you qualify for this. I think it's a very, this is a great opportunity if you do. If you got 10 employees and you used your PPP forgiveness in the 8 weeks, and you could very easily get another 50 grand with the $5,000 credit. To the extent you kept paying employees through the end of the year. So that one, we're not going to give like advice on this call. We're not really don't want to do that because everybody's situation is different. But if you were impacted and by these orders, I think you should dig in and really ask questions of your CPA before you decide whether you don't qualify for something. So just that'd be the advice we give, but it's not, I can't, it's pretty vague. So I don't know, maybe it's something we need to talk to, John Bradford and our representatives about to go get us some answers and say, hey, how, is this something that we really qualify for? There are plenty of consultants out there that are relying on this language right here to call everybody and say, yeah, you should take advantage of this opportunity. And, the processing of this credit, Ron, I think it's on the payroll tax returns, right?
It will be. So for 2020, I think you got to amend 941s. So amended 941s, the same thing for 2021, right? Your quarter is not over, so you can process it on your 941. I think it's 400 employees or less. There's actually, I don't know how to process one yet, but there's supposed to be advanced payments, so you can get the credit earlier than waiting to file that tax return.
Yeah, so the extent that you guys use a payroll service or a PEO to do your payroll, or even if you're using QuickBooks Online or any of these, ways to process your payroll, reach out to the processors and ask them how they're processing these credits, because you may have to supply them the information to process the 941s or the credits themselves. So to the extent you're running payroll yourself, I think we probably can find a link that I can send to Bill and he can send out to everybody that probably to the IRS website or where to do it, where to look. So we'll do that. I think the main thing there really is, the 50% reduction in 2020 And then I think it's,
2021.
is it 80% in 2021, Ron?
I think so, yeah.
Yeah. You know, and that's compared to 2019, right? Or you can use 2020. I guess you got both options, but that's a big enough opportunity that a lot of folks on this call probably potentially could qualify for, and definitely some businesses that were impacted, the restaurants and such. They all should be taking advantage of this. That's all we have. Any questions currently? Bill, I've got a little cheat sheet on the employee retention credit I'll send to you. I'll send you a link for those that process their payroll on their own. And then that's for the employee retention credit. And we'll send you a summary of PPP stuff too. So I'll put together a little document you can send out to everybody.
Yeah, Dale, what would be helpful is today we're gonna take this YouTube video, we're gonna store it, so we'll have a link to the actual online presentation. So if you have some subsequent frequently asked questions, other links that you would find useful, we'll put all that together and send out in an email probably sometime tomorrow to our membership.
Yep. Yeah, it won't take me long to pull this together. We already have it. It just need to organize it in a simple fashion and send it to you. Any other questions out there that we can answer for the folks on the call?
Dale or Ron, has there been any notification from the state on how they're going to handle the PPP loans? I haven't seen anything yet.
If you're on the specific on like forgiveness and if it's taxable?
Correct.
Yeah.
Are they going to decouple, or are they going to stay online with the state, with the Fed?
My understanding they're still decoupled, so it'll be taxable, right? So it's not taxable for federal purposes, but for state of North Carolina purposes, they're decoupled and it's taxable. And that can vary state by state, but.
Right, and that's going to be a big issue that, of course, no one ever really addresses what goes on at the state level on taxes. But I mean, you're talking that could be significant for a taxpayer who has lost a lot during this pandemic as it's gone on. So.
Yeah, right now, the state of North Carolina has, still decoupled from the federal rule there, and no specific legislation to fix that.
Or they may do their usual come in June or July when everybody's
yep.
almost everybody's filed to come up with, okay, we'll do this, and you got to go amend. So thanks, guys.
I'm going to answer a question. Look like seeing the link from John Ekdahl. John, I'm going to answer basically the third bullet. I think you want this calculate. You want me to give you the 60-second calculation for 2000.
No, I have the link. I have the link for it.
Oh, okay, got it. Oh, okay, great. Yeah, sure. Yeah, send that over if you want to send that over to Bill. We'll send our stuff to you too, Bill, and we can just organize it in one spot. Thanks, John.
Okay.
Yeah, thank you, Bill.
Any other questions? John, did you have anything to add? Anything you want to share there?
No, I just it's the number one thing we're doing today, especially in the hospitality area where people are really hurting.
Mm-hmm.
But we've got a link in 60 seconds where they can learn if they qualify and what the dollars are. So we think it's helpful for the people that are in such desperate straits right now.
Yeah, for sure. I mean, that's the whole purpose of this call. So thanks for sharing.
Yeah, lots of variables, as you've just mentioned. If you fill out the basic information with a link, it does all the calculations and says, yes, you're qualified, here's the amount, et cetera. And I just think this is great help for people. I'll share it with Bill.
Yeah, thanks, John. Any others out there that have any last second questions before we wrap up? Sounds like it's all yours, Bill.
Well, Dale, Ron, thank you both for participating today in this special PPP briefing. And if you'll get that information, we'll try to get all this up sometime tomorrow. And I thank everybody who joined us, and I hope everybody has a great weekend as we go into Friday at the lake.
Thanks, Bill.
Thank you.
Appreciate it all.
Thanks, guys.